What's going on, Investomaniacs? Your boy Night Rider here. So I did something I've never done before. I made a hedged bet, or at least I tried to make a hedged bet. So here's the thing. Technically, like if you just go long one thing and go short another thing, that's not necessarily correlated. Is that a hedged bet? I don't know. It's like a half hedge. Like for example, if you go in this particular market environment, if you go long Zoom and short Carnival, is that a hedge? I don't know. Or does it have to be more correlated where it's like, okay, I'm going short oil and long Chevron, right? Is that more of a hedge? I don't know, because I did it the former, not the latter. So I might not actually be doing a hedge, but essentially what I'm trying to do is get out the overall market, where the overall market is going. And I'm picking, so what I did was I picked 10 stocks that I disliked, and I shorted those, and I picked 10 stocks that I liked, and I went long those. But the stocks are not necessarily correlated with one another. They're just 10 stocks I don't like, 10 stocks I like. But the idea, again, is for them to some extent, hedge each other. I think overall, I like this idea. It's something I've been wanting to do for a couple weeks, and this is how I would like my portfolio to go in this direction in the future, assuming it works out the way I think it will, which I don't know, maybe it won't. But here's the challenge, is what I don't understand is the math of what's the best way to do this from a numbers standpoint. Meaning, okay, let's look at the best short seller in the world, Jim Chanos. From the limited amounts of information I could find publicly available online, his short-only portfolio only returns about 2% a year, which doesn't sound like a lot, but apparently for a short-only fund, that's quite good, especially one that's multi-billion dollars, right? And the purpose of the fund is not to make money. The purpose of the short fund is to hedge against your long positions. So if that's the way I view it, where I'm looking at these shorts not as a source of profit, but as a hedge against my longs, if I'm doing it only in cash, then I'm doing 50% cash in longs, 50% cash in shorts. And if I'm making 0 to 2% on the large majority of years with my short position, I'm essentially cutting my profits in half. I don't think that makes sense. Now let's go to the other extreme. You go 100% of your portfolio long, and then you go 100% on margin to go short. And that way you're still getting the maximum amount of money that you could possibly get. If you were typically not using margin and going 100% long, you're still getting 100% of those gains, but then you are hedging all of your long positions with shorts less whatever your borrow rate is. Now, if you're doing like proper hedges, that's maybe cool, but the type of hedge that I'm doing, which again, hedge might not even be the right word, because they're not super correlated, but where I'm just going 50% of my portfolio long, 50% of my portfolio short, not correlated with each other. And there are going to be days where, you're going to have my longs go down and my shorts go up, because that's kind of just the way the market works when you're dealing with uncorrelated assets. So being 100% on margin might be a little bit too much, because then I think you're only leaving yourself maybe like 27.5% or something like that until you hit a margin call and you're basically dead. So that's probably too risky. So I think the appropriate result would be maybe somewhere around like 75 to 80% long with 75 to 80% short. Let's say 75, because the math is a little easier. So you go 75% long, 75% short. It's a total of 150%. So that means you're using 50% margin. With 50% margin, you give yourself a lot more room until you hit a margin call. And considering half of the portfolio is short, I think it's unlikely you're going to hit a margin call at that point. So essentially, and then you have to ask yourself, okay, we are giving up 25% of the long profits to to hedge the remaining 75%. Is that an appropriate trade-off? Mathematically speaking, if you are genuinely not making money on your short portfolio long term, that's probably not maybe not the best thing to do. I don't know. I haven't ran the math, but that's the question that I have. So if any of you have a long short portfolio or have experience with kind of making hedges, let me know if you guys have any thoughts on this, because I'm looking for the percentage and going, okay, right now I'm close to 100% long and 100% short. I feel like that's too much, but to do it all in cash, I feel is not enough. You're giving up too much profit. So is it 75-75 with 50 on margin? Is it 80-80 with 60 on margin? I don't know. And then even at that, does it still mathematically make sense? Does the protection from the kind of like once every 10-year significant drop sufficiently make up for the lack of additional marginal longs on the other 90% of years or whatever it may be where the market's going up? I don't know the answer to that question. That's kind of the math that I'm currently looking into. So thought I'd share that with you guys, and I'll have some data for you over the next 1+ days on how the preliminary data is coming back from my long short portfolio, which is brand new, but I'm happy. I like it. I'm happy I'm at least testing it out. I'm testing out, if nothing else, I'm losing money, and I'm testing a lot of stuff during these last couple months, and I am happy because I think at the end of the day, as long as I don't lose too much money, which granted I am down $92-ish thousand since the beginning of the year, so I got to be careful. But as long as I don't lose too much money, I think I'll be able to learn enough that it'll be good in the long run. Hope you guys have a great day.